Welcome back to AI Research. Today, we are diving deep into one of the most powerful and currently most controversial charts in the world of finance. If you've been following the markets, you know that everyone has been waiting for a recession that just hasn't shown up yet. We're going to analyze the 10-year Treasury constant maturity minus 2-year Treasury constant maturity to see if the world's most reliable economic fire alarm is finally broken, or if the fire is just starting to smoke. The basics. What are we looking at? To understand this chart, it helps to think of it as a temperature check for the economy. In simple terms, it is the difference between the interest rate the government pays you to borrow money for 10 years versus the interest rate it pays for 2 years. 1. The basic calculation. The formula is straightforward. Example A. The normal economy. In a healthy economy, investors usually want more money, a higher interest rate, to lock their cash away for a long time. 10-year yield, 4.5%. 2-year yield, 3.0%. The calculation, 4.5% to 3.0% equals plus 1.5%. What this means, the spread is positive. This is a normal yield curve, suggesting investors expect the economy to grow. Example B, the recession warning. Sometimes, investors get nervous about the near future. They might demand higher interest for short-term loans because they see more risk today than they do in a decade. 10-year yield, 3.5%. 2-year yield, 4.2%. The calculation, 3.5% minus 4.2% equals minus 0.7%. What this means, the spread is negative, below zero. This is called an inversion. Deep dive. Why the ups and downs matter. The blue line on your chart is a tug-of-war between the Federal Reserve and investor expectations. Direct control. The 2-year, the Fed has near total control over short-term rates. When inflation is high, they hike rates, pushing the 2-year yield up and the blue line down. Influence. The 10-year yield is set by the open market. It moves based on forward guidance, the Fed's promises, and inflation expectations. When investors buy 10-year bonds to hide from a coming recession, the 10-year yield drops, further inverting the curve. Is the pattern broken? The 2026 reality check. As of January 2026, we are witnessing something historic. This inversion was the longest in U.S. history, yet a traditional recession hasn't been painted in gray on the chart yet. Some argue the 2022 bear market was the functional recession. The stock market crashed 20%. Resetting the economy without the mass layoffs usually seen in a gray bar period. However, notice the far right of the chart. The curve has finally uninverted, moved back above zero. Historically, the recession doesn't usually hit when the line is at the bottom. It hits after it crosses back into positive territory. With unemployment currently at 4.4% and job growth slowing to a hiring recession, the next few months will tell us if the 10-year minus 2-year spread is still the undefeated champion of economic forecasting. Spread value, market sentiment, economic signal, widening, increasing, growth is expected. Expansion, narrowing, flattening, growth is slowing down. Caution, negative, inversion, high anxiety about the near term. Potential recession. Alright, this is the AI Research. If you find any value in this, subscribe for more. See you in the next video.